Welcome to New York Bio's Virtual Breakfast Series, a digital program started in 2020, bringing you fireside chats with leaders across the healthcare spectrum. This week's SVB episode features Allan Shaw, five-time public company chief financial officer, currently CFO of Portage Biotech, and Christine Docherty, currently counsel at Goodwin and former Federal Reserve Bank counsel.
Good morning, everyone. My name is Jennifer Hawks-Bland, and I'm the CEO at New York Bio. We're excited you're here with us for another edition of our virtual breakfast series. It's a little bit, we are going to be very timely today. Normally we go into more of a deep dive with an individual entrepreneur or leader in the biotech community, and we have both of those things here today with us. But we're really going to focus on discussing Silicon Valley Bank, outcomes, what you should be looking at next. And so we know you're going to have a lot of questions. So please put those in the chat or the Q&A, and Derek and I will get to those as we go through the course of our conversation. A special thank you to Lonza for sponsoring this month's series of Virtual Breakfast. And with that, I will kick it over to Derek to start us off.
Well, I usually say that I'm really excited to be talking about this today. I'm excited to talk to both of you. And I'm happy that we can actually talk about this, but I can't exactly say I'm excited to be talking about what's basically a financial tragedy that's happened in the last week. But I am glad that we can now look at where things have gone, that we can talk to people, talk about what happened, why it happened, and really kind of the broader thing is for startup companies, where do we go from here, right? We're obviously living in a different financial world than we used to be, and ultimately, I think we can talk about how this changes behavior in the future. So without further ado, it's great to have both of you here. Christine Docherty at Goodwin and Allan Shaw, who has been a CFO in a number of different companies, and is just a fantastic startup advisor in the New York City community. So welcome to you both. Christine, we can start with you. Let's have you guys introduce yourselves. And we'll start with you. And I do want to say that Goodwin has done some fantastic work over both on Friday and over the weekend in terms of the educational stuff that you guys put out, being really right on top of the situation. So why don't we start with you?
So good morning, everybody. Thank you for asking me to join. I'm happy to be here. I'm first want to just acknowledge it's been a very stressful time for a lot of people. So I'm happy to share information and perspectives that hopefully may be helpful to you. So I actually had started out my career at Goodwin about 20 years ago, working in banking and financial services. I found myself, I was at State Street Bank and Trust Company in Boston for a number of years. And so unfortunately, this is my third time going through something like this. So in 2007 and then 2008, obviously, we went through the start of the freezing of the credit markets and the start of the financial crisis. So I was at State Street for that. And obviously that caused some kind of significant disruptions in the markets. Then after I was at State Street, I joined the Federal Reserve Bank of Boston. I was the senior lawyer responsible for providing bank regulatory advice within Boston. The other responsibilities I had were actually for the discount window, which is the Fed's liquidity facility, or basically it's the liquidity lines that are offered to banks. And then I was there during the pandemic. So we set up 3 emergency lending facilities, run out of Boston, the money market fund mutual fund facility, the Main Street lending facility, which was actually one of the first times we actually effectively provided credit to businesses. It was done through loan participations. And then we also set up the payment protection program liquidity facility. And so that was also, it was run out of that one in particular was run out of all of the reserve banks. So now I've been on the bank side, I've been on the central bank side. And what we've been dealing with most of recently are our client base of having questions about Silicon Valley Bank as they had customer relationships with Silicon Valley Bank. I'm very happy that we are at a point now where the FDIC had stepped in and invoke their emergency authority to actually provide full backstops for the U.S. deposits for Silicon Valley Bank. I think we'll talk about it a little bit more, but I think we can about the importance and the enormity of the Fed and the FDIC and Treasury's actions over the weekend, which I'm hopeful will actually help calm the markets and give people some sense of relief.
Yeah, well, for a while there, that was one of the biggest things that people were worried about, right? The sentiment that I was seeing is, what is the Fed going to do, and are they going to step in? And the general consensus seemed to be that if they didn't, more panic was going to ensue, right? That this could have actually spread even wider than it did.
Yeah, and their actions were designed to help stem those concerns. So obviously there were questions over the weekend in terms of there were a number of, so there's the FDIC deposit insurance. I think people have become much more familiar with that.
Yeah.
And also the limit. And so then the concern over the weekend was what happens with uninsured deposits. The FDIC's actions, both with Signature and with Silicon Valley Bank, make it clear, again, with respect to deposits that are payable in the United States and booked to a U.S. branch, that those will be respected, and that the depositors will be paid out in full. What the Fed also had done was they established another emergency liquidity facility, and that's available to banks and depository institutions and some foreign branches, but it really allows those other institutions to get ready access to liquidity. So if there are draws or people want to take out money from their banks, the banks themselves they've got significant portfolios of assets that they can pledge to the Fed, and they can pledge them at par. It's very significant because what that means, people have been concerned about losses in the portfolios, either in the available for sale or the hold to maturity portfolios for the banks. The Fed program is designed so that they don't have to realize those losses. They get the full par value of the assets, and then
so they don't have to liquidate in order, they can pledge and then draw down.
That's exactly right. But it's also the assets aren't marked at a discount.
Right. Yeah. Okay. Before we go too deeply, let's hear from Allan. So Allan, tell us about your background.
Thanks a lot, and I agree with Derek. I could certainly find better occasions to be here, but but with that said, I'm a 5-time public company CFO. I've been at large companies, small companies. Suffice to say, what good looks like. I also know what bad looks like. And I've been involved overall raising over $4 billion of public and private financings over the years, including several IPOs, and been involved with the sourcing, the development and commercialization of numerous drug products across an array of therapeutic areas. And lastly, I've had the privilege and burden of being a 7-time public company board of director. I used to think audit was the worst part of governance until I got tasked with compensation, which is by far thankless.
It just gets more complicated, right?
It does.
And personal.
Yeah.
Without question. And this is like the many cycles. I think we've seen this movie before in different versions of it. And unfortunately, when things are good, everyone looks like a rock star. And I think when things get a little shaky, it's tough to navigate. And this is where you're going to see people's true mettle at the end of the day. And, we all know that biotech isn't for the faint of heart, the industrial jeopardies, the binary outcomes. But this was one that no one saw coming.
No.
Yeah, I actually saw a quote from it's Alexis Borisi, right, that runs Curie Bio. I don't know if you all saw it in some of the articles over the weekend, but he said that our risks, I'm paraphrasing, our risks that we take are in the drugs that we attempt to make. The money we put in a bank, we want it to be safe, right? So basically, he was saying, as an industry, we're not using financially complicated instruments, right? It's more that the financially complicated things we do or try to bring drugs and therapeutics to the market. Yeah. Right. So let's step back just a little bit because when you look back at the financial crisis of 2007, 2008, that poor Christine lived through, and a number of on the bank side, that had all sorts of different factors, right? Including, credit default swaps and other complicated financial instruments that were backstopping, right, mortgage markets. And this is different. And this isn't a financial crisis. This at the moment is we've seen 2 banks fail, right? So talk to us a little bit about what precipitated this. And then Allan, I want to get your thoughts around sort of what the CFO community, how you all thought about it and approached it last week as it was unfolding largely on social media.
Yeah, Christine can tell us what happened, and Allan, you can tell us about your weekend.
So I will also say that I think what happened is, there's what we've all observed over the last few days. I'm sure there will be many pages and kind of ink spilled over in terms of kind of dissecting what happened. So just a couple of kind of preliminary thoughts. But basically I think it was the middle of last week, Silicon Valley Bank came out and it had two announcements basically. It had sold some assets in its investment portfolio and had recognized a loss, I think in the realm of about $2 billion. And it also indicated that it was raising additional funds. It also indicated that it had some securities on its portfolio, and if it were to sell those, that it would actually recognize additional losses. Basically the way that people are talking about it now is those losses are derived basically because Silicon Valley Bank had a large influx of deposits, especially during the pandemic and over the last few years. They had invested those in basically longer dated assets, so longer dated treasuries at a lower interest rate. Because of the rising interest rate environment, those basically the value of those treasuries or those other assets, the longer dated assets decreases. And so then you have basically if you sell those assets, you recognize a loss. And so people were concerned about that. But it's a combination of things. Then people seem to get, and I'm not sure exactly how it started, but people seem to get concerned about the bank itself. And then there was a lot, I think we'd reference this, but kind of going through social media and other communications about what to do. And I think one of the biggest lessons, and I'm really glad to be here, and I think this will be something that we talk about a lot going forward. People do want their assets to be safe. There are a lot of different types of investment opportunities and a lot of different options. But they also have different risks to weigh. And so part of it is that actually one of the things that people can do is understanding that many things may not be safe. There are some that are safer than others or provide other benefits, is actually just understanding the nature of those investments and what the risks actually are. And so I think that actually just from a financial stability perspective can be helpful to people in actually knowing going into it, and when something happens or if there's a disruption, what their exposure might be.
Allan?
No, that I totally agree with that. I think, if you look at it at the highest level, the bank that specialized in technology and life sciences really did not understand that market at the end of the day in terms of on a macro level. They thought they thought the funding environment would continue, right? They thought the punch bowl would continue to be replenished. And they they thought the era of free money would continue forever and the interest rate environment would stay low. And they got caught by the confluence of both those things occurring, where they got stuck with short-term assets and long-term assets and short-term liabilities. And those things are not sustainable, particularly when you lose confidence. When the news first came out, or when speculation first started coming out, I shook my head and said that can't be true. This is an S&P 500
Right.
company, but I think, and my first reaction is that if you panic, that's probably the worst thing you're going to do.
Right.
Right. And that was my initial reaction was, you should, if you're going to pile on, people are going to get hurt, people are going to lose, and there's going to be a lot of destruction. And I think in this environment of social media, it doesn't take very long to start a blazing fire.
Right.
And I think because of that, and because banks are all about confidence, right? The moment you erode confidence, it's game over. And I remember reaching out to some folks over there on Thursday, to try to take the temperature and get a sense of what was going on. And unfortunately, it didn't seem very good. When I posed the question, you want to try to get in front of this as much as possible. You got to close your financing and make sure that perception doesn't become reality. And I think what I heard was perception had already become reality.
Yeah, and it's funny, right? The word of mouth and panic can reach so many more people so quickly, right? And we're in an era where you can move money like this just without at the drop of a hat. So I think if this were probably even 5 or 6 years ago, the speed at which the deposits flowed out, right? Because that was really the big
Yeah.
thing. How it was the I think people withdrew something like $40 billion between Thursday and Friday, right? That I don't remember if that's the exact
Something around there.
number or whatever it is,
Yeah.
but it was a significant fraction of their deposits of their cash on hand. And all of that was basically due to a lot of people panicking and that spreading like wildfire. And there were voices trying to tell people to remain calm, but it was basically Kevin Bacon at the end of Animal House, right? It just it did not have the desired effect.
Yeah. So and then I let's talk a little bit about so in the one of these things is not like the other sort of parlance, right? SVB, because they were known and because they banked so heavily, right? Sort of entrepreneurs and startups, and so many of our biotechs are early stage. Talk to us about how that also played in to the impact on our sector. And I've seen figure, I mean, everybody's seen figures, right? And like that that they banked half of venture-backed startups in 22, and that about 12% of their holdings were life science and healthcare funds, which that in and of itself doesn't seem as sort of indicative as the half of venture-backed startups in 2022, right? Because you're talking about tech, not just biotech, right? So, and all sorts of venture-backed startups. So talk to us about the disproportionate impact on sort of our community. Allan, we'll start with you.
Ian, it's I think it's very impactful. It was really a part of the fabric of the ecosystem on so many levels. When you started to think about it, on a couple of levels, I find it's funny. I'll come back to my observation later, but it is so significant. And then over the weekend, when we, how did I spend my weekend? It was very clear that initially you failed to appreciate the domino effect associated with all of the collateral consequences that were potentially occurring. Right, everything was theoretical. The weekend couldn't have come soon enough. It was like a TV timeout that lasted for 2 days. And during that, I think it gave the government certainly an opportunity to come up with the backstop that raised a different question of, can I really access the money at the end of the day? But that seems to be getting better. But overall, coming back to the central question, it seemed not only were companies worried about whether they're making payroll, as you touched on earlier, Jennifer, but there was a question whether or not the VCs were going to be able to honor their investing commitments, right? Deals that were scheduled to close, could they actually come up with the money to, the companion pipes and whatever else was going on out there? So it was, it was to be seen how far back that was. And until the Fed came back, you didn't understand the level of exposure. And I guess that's a good segue to my observation. Given that this was an institution that was so central to the ecosystem on so many different levels, and everybody had banked with them more or less. I mean, it was far and few between if you weren't involved with them in some manner. But when the analysts went around and surveyed the community to see who had exposure to Silicon Valley Bank, no one really had exposure to Silicon Valley Bank. So on one, I don't know how you make of it or reconcile those two things, but
right.
But at the end of the day, it's a problem, right? I think they knew how to work with companies. Companies could operate effectively with them, and there was a level of empathy. Now that people are scrambling to open up bank accounts and figure out what they get. If you can get your money, you want to get it out as quickly as possible. So now you're going to the back of the line at banks that don't necessarily have the empathy or the tools. And right now, everyone's just opening up bank accounts, right?
Right. Well, I mean, how many bank accounts does a company need now, right? And if you have a healthy balance sheet, I mean, I don't think you can open that, you can't open $250,000 bank accounts, right? You just can't do that. So, what is a company supposed to do now? I mean, if you're a biotech company, let's say you're a company that's going to put a molecule into the clinic, let's say you have $20 million sitting in the bank, like how many bank accounts do you need, and what do you do with that money?
More than you thought you needed last Wednesday, I'll tell
Yeah.
you. My thoughts on that is I think you certainly need to have a bank account with two different institutions.
Hmm.
In this day and age with social media, I think you just can't get caught out. And, from a standpoint of risk management, you should certainly have one with two. And I think right now the big banks are all pitching, I'm not going to fail. So, I think that's going to put it hard on the smaller banks. And I don't think people are going to want to take the risks with smaller banks, right? No one got fired for, using a big bank, but if you use a small bank and it fails, there's going to be a lot of finger pointing. That's one aspect. The other thing I think you can do is you can actually structure yourself to protect yourself. So even if you're in one institution, for instance, if you've had your money in third-party money market mutual funds that are government backed, those are off-balance sheet securities, and therefore you're outside of that. Those are not the bank's risk doesn't put those assets at risk. And I think, if you can manage your money effectively and understand what your capital needs are, that should really minimize the number of bank accounts that one would require.
Yeah.
So and maybe this is a Christine question. What are we'll call them cash management tools, right? That companies should be looking at and thinking about and wishing they had maybe last week. At least it would have avoided the panic. Luckily, right, they have access to the capital, but now looking ahead, what should they be thinking about?
Yeah, and so as Allan had mentioned, there are a variety of different investment options. So you can purchase money market mutual fund shares. Some of them they've got different risk profiles associated with those. So some investment in government securities, but I think it's also governments and agencies. So there is still, some potential credit risk. It's lower than for others. So that's one option, and is just to purchase and then hold those instruments. The only thing that I will remember, and this is why it gets a little bit more complicated, is, going back to 2008, some of the reserve fund broke the buck. And so that caused concern that people had. And then there was actually a guarantee for the money market funds. When I was at the Fed, we worked on a lot of money market mutual fund reform and trying to actually change some of the structuring for those products so that they were less likely to cause people to what they call as run, but then also to have ways that you could actually stop the run if it occurs. So there was restructuring work that was done following the financial crisis in 2008. So my only point in this is, again, each of these instruments have many of these instruments have some risk associated with them. Yeah. And so there have been efforts to try to mitigate those risks over time, but they still remain. But the money market funds are one option. Some people, you see them, they just invest in the money market funds directly. Others, people will want to have cash available because they're using the deposit accounts basically for operating purposes. And so you might have a sweep product. And so sometimes you'll see funds that get swept into money market mutual fund shares. And typically what we've seen is generally there's a deposit agreement. You have to maintain a certain balance in that deposit agreement, basically a minimum balance. And then the money gets swept into the money market mutual fund share. When that deposit balance goes down, the money market mutual fund shares then get released. There have been some complications through the days because there's also a settlement risk, basically. Oh, yeah. Because it takes a couple of days to actually get the money in and out of the money market mutual fund shares. Yeah. There's also, to your point, Derek, there are products that banks offer, which are basically, it spreads the deposits across many, many different banks, up to $250,000 in each bank. But when you get into the details a little bit, sometimes the money can move around between banks. But there are products that basically try to give you effectively $250,000. So to your point, you don't have to open the bank accounts. You go to a bank, you say, I want to participate in this product, and I want you to spread my money for me. Those are very common. Go ahead.
Sorry, I didn't want to interrupt you in the middle, but the other thing that I want to understand here is what this kind of means for the banking industry, right? Does this basically put a spotlight on kind of short-term risks for the banks themselves? And does that kind of depress, all of the banking stocks across the sector? And the follow on here is, does this make banks more conservative, or does this make banks, how to phrase this, desperate to find places where they can be more aggressive? Right? There aren't a lot of kind of high yield things that banks can do with their money. So what does this do for banks and their attitude towards how they manage their own earnings?
So I think one piece is just thinking about, again, first kind of understanding fully what happened and then thinking about what it means from a risk management perspective. I mean, so the first piece is looking at the banks. For example, people are focusing on how many banks have uninsured deposits, and does that make them? I mean, there's the concept of are the deposits sticky or not? And so I think there'll be a lot of more looking at the potential or exposure because of again, people are looking at this in terms of the amount of uninsured deposits, trying to understand what that means in this particular environment. I think also understanding, to Allan's point earlier, right, you had a mismatch between the ability to demand return of deposits immediately versus the assets that were basically available to support the return of the assets. So I think from a asset liquidity management perspective, there'll be a lot more focus on that at the banks to make sure that they're actually in a position to do it. And again, the Fed's actions are meant to address some of those issues in the short term so that it actually gives the banks breathing room to kind of figure out what they need to do from a liquidity risk management perspective. So I think that's the first piece, quite frankly. I don't know, Allan, if you have kind of it, but
So do you think, from a market standpoint, I know that like the S&P bank index, right? The bank stock index was down about 4%. And like when you see something like this, like I would have frankly expected it to be down more. But do you think this idea that the Fed had stepped in before with help with liquidity, it set a precedent, right? That the Fed was willing to engage in order to stop more systemic sort of reaction within the market.
Yeah, and I will say I'm a regulatory lawyer, and so I don't on the finance side is so just to be clear, my orientation. But the Fed has also said, right, the Fed stepped in. I mean, that hopefully again from the banks will help the banks feel more comfortable that they can manage the liquidity risks and the liquidity draws. And then there was also language basically at the bottom saying that they're basically ready to stand and to do more if that's necessary. And so they will be very closely monitoring the situation. I think the president had also come out with kind of a similar statement yesterday.
Yeah.
So it's useful to remember, to your point, it's the point. There has been a lot of rapid changes and developments over the last 5 days or so. And so it continues to develop, but the agencies are certainly very closely monitoring that and thinking about what would be appropriate.
And I would say, a lot of people are trying to see because there's something to extrapolate here. And certainly people are trying to extrapolate from what's transpired. My personal perspective is this was a case of some mismanagement and that converted into a loss of confidence. And now it's turned into a bit of a witch hunt. Which is, so I think what the Fed did over the weekend was really important, at least certainly from our industry, perspective. People are going to speculate, what's going to go on with the Fed and are they going to stop raising rates? And that does have cost of capital implications for us. But putting that aside, I think the big concern was, certainly there was the backstop, the financial backstop, and what the exposure levels people had on that. But the other one that was called out by folks was the FDIC has never really had a lot of experience in managing a situation where all the depositors are cash burning companies and that they're really, this is their mattress money at the end of the day.
Yeah.
And they need access to it. And I think the backstopping here has facilitated, a lot of those concerns and helped, change the tenor of the conversation from are we making payrolls to not.
Yeah, over the weekend, I was listening into a couple of, I think 3 or 4 different, sort of webinars, a couple of good ones. So thank you. And it hadn't even occurred to me, right? Even though I too am a lawyer, right? Like I have I took secured transactions in law school, but literally like that is my extent. But I was listening to people ask questions about can our board step in with sort of rescue loans? And then what about the sort of the subrogation rights, right? With existing lines of credit and SVB and all of these things that I hadn't even thought about. So kudos to all of you who spent the weekend trying to figure out some of those things sort of from an emergency standpoint. But then let's also shift and talk a little bit about SVB. Often, I won't say all the time, but often, right, with their funding agreements, they required companies to solely bank at Silicon Valley Bank, right? And first of all, is that industry practice? Is that standard? Or is that something that is really more applicable to the sort of the startup tech industry? And then how do we see that? How did that contribute to the panic? And what should companies think about going forward on that?
You know, I think overall, I mean, I certainly get the fact that they want all the cash at the bank, you know, in terms of just from a security. At the end of the day, they're lending money to, you know, ideas. So anything that's tangible and hard, they want to have access to. But there shouldn't be any reason, it's certainly going forward, that, and I think it would have been fair in any situation, that you can still have a bank account, right? You still need you need that safe house.
Mhm.
Yeah.
Yeah.
Although if you think of them as, now we get into the interconnectedness of the industry, right? Whether it's tech or whether it's biotech, right? They weren't just a bank, right? The people at the bank actually were maybe not advisors, but they were connectors in the community. They were genuinely trusted for a lot of different reasons. And you get to this kind of favored position that they're in, and it lets them do things like, well, if you want access to all of the people and the things that we have, and if you want to tap into our networks, you have to bank with us, solely. We can be your sole provider. I think if you have that position in the marketplace, then you can do that. But I would imagine that given what we just saw, that nobody's doing that anytime soon, right? The risk of your deposits going away is not worth really anybody's connections, given how small of a pond everything is.
I also think it's going to be a lot harder to get venture debt. You've lost a leading provider there. So, in an environment where capital is becoming scarce, people are trying to manage their cost of capital. This certainly hurts.
I mean, venture debt has not really been the bastion of top flight institutions. So there were a few that were trusted that you can go to, and now one of those is gone. So Christine, why don't you jump in? You've been nodding your head. Like, let's give you some space here.
Yeah, so this maybe so there's something that are referred to as the anti-tying rules, which are basically, there's a statute and then regulations at the regulations on point, but that basically preclude banks from saying, if you want access to what are considered traditional banking products, you have to buy something that's not a traditional banking product.
Yeah.
So those wouldn't necessarily have applied to what we've seen in this case, but I do think, I mean, again, amongst many things, and it will take time to come out, that the regulators and the tying rules are by statute. So Congress will think about whether those kinds of requirements are appropriate, or whether they're actually regulatory limitations that should be imposed on those kinds of requirements, the concentration expectations.
So, go ahead.
No. I mean, I think it sounds like from the discussion, even the discussion here, it sounds like the market will actually move away from that more quickly than you'll get a regulatory response.
Right. So what happens? Okay, so let's do a sort of non-hypothetical but non-specific company scenario here. How's that for caveats? So Jennifer's biotech had a loan agreement. We had venture debt from Silicon Valley Bank, and I had to bank there. So if right now, as we sit today, the FDIC basically owns that agreement, right? Because they put Silicon Valley Bank in receivership. If Silicon Valley Bank's assets are acquired from the FDIC, what happens to that agreement? So can I go ahead in the interim and open bank accounts elsewhere and move my cash, or am I still bound by those terms of my agreement that require me to bank at Silicon Valley Bank?
So we're a couple of things, and I think, again, it goes back to the fluid nature of the situation. It does sound like people have continued to be able to draw on some of their lines, which is good. There had been, I think the FDIC is given, or even over the course of the day yesterday, people were hearing different things. So quite frankly, what we're recommending, especially because you don't want to trigger a breach under the agreement, what we're recommending is people talk to their counsel. And the FDIC is also, people are available at the FDIC. And again, throughout the day yesterday, we're hearing people actually getting through to their contacts at Silicon Valley Bank. So at this point, again, given, and the FDIC had kind of given, it sounded like they were giving, more clear instructions yesterday. Make sure you actually comply with the expectations, especially, quite frankly, they're looking to sell their portfolio. You don't necessarily want to have breaches on it.
Exactly.
So I think the best advice we can give now is actually talk to your counsel, and also try to reach out to the bank or the FDIC, because we are hearing, it was difficult over the weekend. We are hearing people actually getting through and being able to talk to their relationship person at Silicon Valley.
Okay.
Yeah, I echo that. You should be able to reach out to them. I also understand people at the FDIC are picking up phones, so the wait time isn't as bad as you think.
Yeah.
It's probably better than being on hold for a flight delay these days.
No, it might be a little higher stress than that.
Higher stress, but maybe not as long a wait.
One would hope not. I don't know that well, it's funny. I think the airlines want to make you sit on hold. It's not clear to me that the FDIC has oceans of people that are there to serve you when you call with an emergency, because they don't want them. So I think it's important to talk about let's talk about the actors in the community for a bit here. And I wanted to actually start more on a positive note, right? Because one of the things that, I've seen over the weekend, was that there are certain folks within the venture community that immediately stepped up and, number one, called for calm, and number two, when things really got bad, and I'll highlight both Bruce Booth at Atlas and Peter Kolchinsky at RA Capital. The first thing that Bruce did was, every single Atlas company is going to have access to whatever funds they need. We will issue you short-term loans. No one is going to miss payroll, right? I think there are a lot of venture folks that distinguish themselves over the weekend as, kind of knowing who's there for you when you actually have them on your cap table and on your board. And that's an important thing.
No, that's fantastic. And, I think a lot of companies wish they had more sugar daddies like that out there.
Come on, sugar daddy is the word you picked there. Come on, trusted partner, right?
So, no, for sure, absolutely. It's good to have your back, however you want to characterize it. And it's everybody who's developing and working right now. We're doing it a lot of times without any mats, right? These are high wire acts. So, when there's something out there that can lessen the blow and really protect you, as we were saying earlier on, against the financial risks, we're not expecting those financial risks. We had been taking them for granted. And I guess the wake up call here is that's not something you should necessarily take for granted.
Yeah. So the other side of that coin is, you imagine you're, and either a CEO or a CFO at, a company that is not yet in the Atlas or RA category, right? Imagine you've raised a couple $1 million and you're early. What are some of the things that you want to think about going? Obviously, everybody would love kind of blue chip capital in their companies, but let's say you don't have that yet, right? So what kind of safeguards do you want to take? Is this something where you think about, Allan, adding someone, Allan, with your experience to your board? What kind of things could kind of smaller companies and earlier stage entrepreneurs think about now? Because I think a lot of the guys that have that level of capital probably have really kind of good dyed-in-the-wool folks around. Let's talk about what some of the smaller guys can do to help with that. So, Christine, do you want to take that?
Sure, I think, and again, it's difficult, but I think having people, and as we've learned, right, the folks on the phone today are, they're specialists, they're experts in particular areas, and their orientation's different. This is a whole different set of risks that they're facing. Mm-hmm. So I think actually, your suggestion about having somebody on your board or reaching out to people who have that expertise, right? You don't want to spend all of your time having maybe your CFO, but our organizations don't want to spend all of their time building up expertise in an area that's really not primary to their mission operations. But finding people who do have that expertise who can help them, I think, is really important. And to your point, I think, board position or something like that, or advisory member of the board who can really help think about it and set it up for the beginning, but then also think about as the companies grow and they have different needs, thinking about or reassessing what the risks look like for them from a capital, basically a cash management perspective.
Yeah, I agree with Christine. I don't think there's any reason to go out and buy a cow if you really only need a steak.
That's gold. I remember, so this is interesting. This was ages ago. This was probably 10, 12 years ago. I remember it was at a New York bio breakfast, and Ron Cohen was the speaker. And someone asked him, what the most important thing to do, in your first year as a biotech company was. And Ron thought about it for a second, and he said, survive. And he goes, really, the most important thing you could do is, he goes, there's going to be stuff that comes up that you didn't plan for, and your job is to get through that, right? So on the other side of this, right, what are some of the things that you think folks are going to be, do you think how people managed this kind of crisis and how they're structuring things going forward, do you think this is something that kind of almost turns into a diligence question for venture folks, or turns into a little bit more of a conversation piece around how you're running your company and how you're kind of setting yourself up for the future?
I think it's certainly, you've added a couple of questions to the diligence questionnaire. No, they may have already been there, but they're definitely there now. I think people don't know what they don't know, right? And when at these smaller companies, generally they're led by somebody who has strong depth in a particular area, and they don't necessarily have the business breadth. So, I think you got to have self-awareness, and the board should have self-awareness as well to make sure, I think one of their jobs is to help identify blind spots. And address them. And as we said, I mean, there's cost-effective ways. Maybe you need somebody at the board level. Maybe you need somebody at an advisory level. I would say, generally speaking, at younger companies, the financial function is taken for granted, as long as you're paying the bill, right?
Yeah.
This is how much runway we have. This is who we're going to play. This is who we're going to pay. Here's where we run out. Congratulations, your job as a CFO is done.
Yeah, and usually that's one of the, generally speaking, I mean, I agree with time when you generalize, you're going to get something wrong. But a lot of times when you see the construction of C-suite and companies, that's usually the last seat that gets filled before the companies go out to go public. I've always felt it was like, Ringo Starr for the Beatles just before they hit the road.
Yeah, and I also, the other point is, I don't, and this will betray my own ignorance. I tend to work with a lot of financial institutions, and sometimes the kind of very complex financial institutions. But from a risk management perspective, right? Do you go through the exercise, and we do this with the banks a lot, it gets more complicated, but do you go through the exercise of thinking, okay, what's my business? What are the risks that I'm exposed to? Do you understand kind of the categories of risk? So not just execution on the products that you're developing, but basically the other relationships you have with other parties. And so starting to think, and again, this is, again, will betray my own ignorance, but is there a process and a mindset for thinking about risk identification and then risk mitigation, kind of across all areas of the business?
Right. Well, and two, when you think about, like, let's over the weekend, right, when before we knew if companies would have access, right, to their existing capital, it wasn't just the risk it was risk about making payroll, as Lauren Busby points out. It was potential personal liability risk for not making payroll to board members and others, right? There was risk for the larger, all of your vendors, right? They all of a sudden had exposure to you if you weren't able to meet your obligations. And so I think that's what created this sort of, so I think that the question is stepping back, like, okay, we saw this cascade of events. We don't want the pendulum to swing so far that people are making what would have seemingly been irrational financial decisions because they're so risk averse. But how do we make sure the pendulum moves maybe a little, but still is relatively in the middle of the spectrum?
The problem is the pendulum never stops in the middle.
Yeah.
But I think doing contingency planning exercises can be helpful, so that you've thought a little bit about if it happens, because this happened to be an issue related to a bank failure. But if your bank has a cybersecurity attack, that could present problems. The same things like payroll and other things. And so then the question is, so that's not totally outside the realm. So it might be worth thinking about, again, kind of access to your assets. Because it's not just necessarily in these circumstances where that might be disrupted for some period of time.
Yeah, that's true. And so so I'm an early stage company, like we'll take Derek's example, right? I have raised a couple of million, and now I'm like, oh my gosh, I have to scenario plan this. How do I even start? Like who are the people they need to reach out to? Like, how do they find the Allans of the world, and how do they make sure they're asking the right questions of the right individuals?
So I think to some extent, a good place to start is probably your counsel, just because they will have, a network of people who they can start talking to, and to figure out who's the right, and to think, the other piece is finding someone who's going to be helpful and well positioned to help a particular institution. And that'll depend on kind of their experience and their knowledge, both of the risk that the institution's trying to address, but also its own operations. So I think that would be the first place that I would start when I need somebody, is just start reaching out to people who I know who may have other connections and may be able to help me.
Yeah, I'd echo you. I think your professional universe of professionals, your accounting firms, IR firms, I would say people in the space who've worked with people who they like and they respect. Board members are a great source. Other CFOs, their network. I think that there's a lot of, resources out there, but I would say, to your point, Jen, they're not necessarily harnessed. It's not like you can, you go to a Craigslist for this.
We hope not.
Yeah,
Craigslist
yes,
is not the first one I would turn to. But for,
the other piece that I would say is, sorry, some of these things sound more may sound more complicated. They're really, they're things that everybody can learn in terms of kind of basically how to think about these issues. It doesn't mean you have to become an expert in them, but it's things that people can become more attuned to. So I don't want it to also sound like these are highly complex issues. Sometimes they get a little bit more complicated, but there's a general orientation that everybody can develop to the extent that they haven't already.
Yeah, I think it's important.
Sorry,
I was going to say, you go.
I was just going to tack on that there's also simple things people can do, like, what's our treasury policy? How do we want to manage our assets? And, that could start with management, that can start with the board. I think certainly those are questions that should have been asked that probably haven't been asked, and those are probably going to be one are getting asked now.
Yeah.
I think for the earlier stage folks, it's important to note, especially if they don't realize this, that this is a smaller industry than it gets credit for, right? That these circles overlap a lot, and the folks that you work with, either on the legal side or the accounting side, are very likely to know and be connected to other people that can help you, right? So for any CEO that's worried about picking up their phone to call their lawyer because they think it's going to cost them $1,000, it's a worthwhile phone call, because you are probably no more than 2 degrees away from somebody that can help you, right? And that's actually a really important thing. Like, when in doubt, pick up the phone, call people in your network, because you are very likely connected to some folks that could be helpful for you.
Christine, were you going to say something?
No, and I know our law firm and other law firms are starting to put out kind of, information that you can look at to talk about some of the commonly asked questions that we've been getting today. So, whether it's Goodwin or whether it's another, it's good to reach out and to actually look at some of those materials. They are designed, they're designed by people who know both the specific issues on the regulatory side, plus the people who know the business, and meant to speak in a way that's kind of relatively kind of easy and understand, and kind of tailored to the people who are actually reading it. So I know I find them incredibly helpful. And I'd encourage people to just take a look at some of them. Again, there are lots of different firms that are doing it. But there's helpful information, and that can get people starting to think about, one, who's, what information is helpful, but then also just what are the questions you need to start thinking about, or might.
So we had a question, and I actually wanted to head there. So one is one thing we saw over the weekend, right? Or maybe it was Sunday, or it runs together. I'm sure it runs together for y'all. Is that HSBC, right, bought Silicon Valley Bank UK for £1, right? And so assumed, right, that operation. Our US federal regulators failed to find a buyer, right? From what we understand from the auction on Sunday, mulling whether to do it again. And there may have been something that's come out while we've been talking. And then we had a question, can we talk about SVB's current status as a bridge bank? I think actually it is a bridge bank set up, right, by FDIC.
Right.
And then said here, the recent discussions with the new SVB CEO seem to suggest all new deposits are now FDIC insured. Talk to us about sort of what the current status of the SVB assets are, and what we see going forward with the Fed's attempt to sell those assets.
So I think that's right. So the deposits at the new bank, at the bridge bank, they will be respected. You don't have people should not worried about people losing money at the kind of on losses at the bridge bank. One, it's a different structure. It's also been set up by the FDIC specifically for the purpose of holding the deposits and making them available to customers. Right. They did provide information yesterday. Again, if people are here experiencing different things, I'd really like to hear that. But the way that their action was designed yesterday was to make sure that the money keeps flowing, right? You can use your debit account, you can use your checks, you can, right, depending on what you can wire funds out of the account. Funds can get wired into the account. It really was designed to make sure that the money continues to flow through the system without people having to worry about what happens with their funds. So I think from that perspective, so the bridge bank is there. The bridge bank it'll be limited in duration. They haven't said how long it's there, but its purpose is to facilitate the transmission of funds from people's accounts to allow it to come in and to continue operating. That's why they took the actions that they did. So people should, again, if people are really having concerns or problems, that'd be useful to hear about it. But as far as I know, everything should be operating kind of as it was, as of Tuesday last week.
Same logins and the whole bit, right?
That's my understanding. In terms of the Fed's action, the Fed's action is aimed at other banks and making sure that other banks have sufficient readily available liquidity, so that if depositors want to take their money out, they have the ability to do that and to fund those deposits. And that is intended to provide kind of comfort to the market and comfort to depositors to know that their funds, if they want them, they can get them.
And so obviously, like, we've seen a lot of flux, and I think, I know First Republic is an example, right, of sort of a big swing, right, in their stock price, and other sort of regional banks. We had a question earlier about implication to local New York banks. And so, but I would say, like, sort of broadly, like, not necessarily just community banks, but banks with a smaller footprint. What do you see as the sort of impact on those banks?
So I think for some of them, they'll, part of it will be interesting to see how their deposit balances increase or decrease over the course of the time, in terms of, so that I don't know where people are going to decide if they, either, again, I think they'll be facing that or facing questions that people have. I think probably a lot of the same questions, which is that people are trying to understand what they have on deposit, where exposure is to, banks throughout the country, in terms of what it means or what kind of exposure they have to the credit risk of the bank. So I think that's probably the first piece, which is just people trying to understand what their relationship is, get a better understanding of it, and what their exposures are.
Allan, how would you advise like CFOs to think about sort of banking relationships writ large, going forward?
I certainly value banking relationships, and I think they're important whether you bank with the bank or not. I think this week just underscores the need that you need to have other banking relationships irrespectively. I would probably, from a risk management perspective, I would question why somebody would use a smaller bank, particularly in this environment. I don't think, I think I would, if I, from a board perspective, if I came across that situation, I'd ask why are we doing that? Is there a particular reason for doing so? Right. Otherwise, I think, you're in safe hands. I remember earlier in my career when involved in a different industry, and we were competing with AT&T as an upstart. And, when we were trying to make sales, and compete. You come across people, you don't get fired for hiring AT&T, right?
Yeah.
It's simple as that. So I think it's going to make it harder for them, particularly notwithstanding what's been done to kind of calm things. First Republic is kind of being used as a canary in the coal mine right now. There's still a bit of a witch hunt going on right now, and that's going to probably hopefully stop. But who's to say? So I think you got to protect yourself, because if First Republic falls, then I think it gets scary, because then they're going to move on to the next one.
Yeah, they were up significantly in the pre-market this morning, so I checked on that before we got before we got on where I used them as an example. They were up like about 45% in the pre-market. What about so we had a very specific question, which I'm going to generalize it a little bit, and this is the sort of practical sort of outcome. If a payment, and I think this is more of a Christine question, sort of payment processed on Friday morning using SVB accounts, it came out of the depositor account, but it never made it to the recipient. Sort of how does that fall out, and what are the practical implications of those types of transactions that were occurring in the normal course of business?
Sure. So the answer this morning is very different from what it was on Sunday, just to put that in perspective. So I'll explain the two. So the answer this morning is basically, it's part of the answer for both of them is it's unclear what happened with the fund, with the transmission. So I hate to say this, but I think if it's not going through, or if it hasn't settled in a couple of days, it is worth calling Silicon Valley or the FDIC and asking them about the nature of it and what they're doing to actually release those. We did have, a lot of clients that found themselves in that position. The concern on Sunday morning was, does that mean the funds never left what I'll refer to the master account of SVB on the books of the Federal Reserve? Right. So if the funds had never left SVB's enterprise or control, thank you. Basically, then it would have been considered a deposit liability on the books for the customer who had tried to send the wires. So basically, then you would have considered that if it was over 250, it would have been an uninsured deposit liability. It's possible, though, that the funds actually left SVB's control and just got caught up in the process. I think that's unlikely over the course of the next 2 days. If the next couple of days, if it doesn't go through, you can feel relatively comfortable that the wire just got stopped in process. But I'd encourage people, again, I know it's a lot of phone calls and people are worried about spending time, but call SVB and ask them what happened to it. I'm not worried about the risk of loss for the funds themselves. It's just a question of, do you need to initiate a new wire? Are they planning to initiate new wires? Do they know that this wire got held up, but it's going to go through? Right. Yeah.
Those are good practical questions. As we come to the top of the hour, what are your last pieces of advice or things that people should look out for this week? What are the takeaways? The very last takeaways.
So, I think to Allan's point, it's good as a measure to have other banking relationships, again, for a whole variety of reasons, or at least a second banking relationship for a variety of reasons. Again, not least of which could be that there could be a cyber attack that might affect the ability to move funds. The other is to spend some time getting a handle on what your banking relationships are and what kind of understanding what the exposures are that you have based on the current structure. There are a bunch of, as I mentioned, lots of different law firms have different articles about different cash management options. And so to take a look at those and try to understand what the options are. And then I think to the discussion earlier, to the extent that there's something that each of our, the participants here either don't understand or want to find an expert, reaching out to their network to see if there are people who can help them kind of understand.
Allan?
No, I agree with everything that Christine just said. And I would say, I think this should be taken as a wake-up call. It's a good time for a health check, do a little introspection and learn from this. You don't necessarily want to have all your eggs in one basket. I think you can, even if you want to have them all administratively through one institution, there's things you can do structurally to protect them, as we talked about earlier, and just be aware of what you don't know, right? I think we all know what we do know, and if you don't have that self-awareness, identify those gaps, and I think there are different ways, as Christine touched on, to solve for them.
And as New York Bio, like obviously we work with everybody in the ecosystem. And so we have lots of strong relationships sort of across the board. So if you also are, if you're not sure or you need a new relationship, we have lots of good commercial bankers. We have lots of new, good venture individuals. Like there are lots of people in our New York Bio ecosystem that just like Christine and Allan are ready to help. So reach out to us. If you need connections, we're happy to make those. But thank you both so much for participating. I know this has been quite the last sort of 72 hours, and we really appreciate not only your time, but your expertise as we talk through these issues raised, all three of you. Thank you.
All right.
Thank you.
Thanks so
Bye.
much, guys. I hope everyone spends the rest of this week and next weekend talking about college basketball as opposed to bank finance. All right.
Exactly. Yes. Get your March Madness bets in now.
That's right.
All right. Take
All right.
care, everyone.
Have a great day,
Bye.
everybody. Bye now.
Bye-bye.